Welcome back to the deep dive. Today we're jumping into the share market, specifically looking at some great material designed to get you from, let's say, fearful of the market to, well, genuinely informed and quickly. Our whole mission here is to pull out those essential bits of knowledge, the stuff that really makes the difference. Because the potential is huge. The sources we're looking at show returns in that 12 to 18% range over time. So why are so many people still on the sidelines?
It's a huge paradox, isn't it? You've got these absolute titans, Warren Buffett, of course, but also in India you have legends like Rakesh Chunwala, Ramdeo Agarwal,
R.K.
Damani, right. They built fortunes. But the statistic that always gets me is that only about, 4% of Indians actually invest. And the reasons, they're not complex, they're just very human. The sources point to things like a low appetite for risk, a real lack of basic knowledge.
And fear. I imagine a lot of it is just fear.
A huge amount. There's this historical scar left by the big scams, Harshad Mehta, Ketan Parekh. That fear is a powerful, powerful force.
It's the ghost in the machine. But here's the core idea we have to get our heads around right away. The market itself isn't the enemy. People don't lose money because the market is rigged. They lose money because of, well, ignorance.
Exactly. Knowledge is your only firewall.
Okay, so let's start there. Let's unpack the absolute basics. How does the stock market actually work?
The analogy in our source material is brilliant, I think. It's just like a vegetable market.
It's the best way to think about it, honestly. It's all just supply and demand. A company has great news, more people want to buy its stock.
Demand goes up, price goes up.
Price goes up.
Yeah.
And if there's a crisis, everyone rushes to sell.
Supply floods the market, and the price tanks.
That's it. It's a marketplace. And for us, that marketplace is mainly the NSE, the National Stock Exchange, and the BSE, the Bombay Stock Exchange.
Right. So now let's get to the biggest trap for beginners. This is where it gets really interesting, because it explains why so many people fail right out of the gate. It's because they rely on tips. Oh, the hot tips. It's the addiction to the shortcut. A beginner's journey almost never starts with a book. It starts with a WhatsApp message.
Yeah.
And there's a life rule in the source material I absolutely love. It says, TPS only work in restaurants, not in the stock market.
That's good.
It's perfect, right?
Yeah.
Because if someone really knew a stock was going to double tomorrow, why on earth would they tell you? They'd be quietly making their fortune, not selling a course.
It's a fantasy. So if tips are the fantasy, what's the reality? The material points to one single concept.
Sure.
Valuation. And this brings us to the PE ratio.
This is it. This is probably the single most powerful concept that big investors know and, frankly, rarely share in simple terms. PE stands for price to earnings.
Okay.
And all it does is answer one question. How much money do I have to invest to earn 1 rupee of profit?
So it's a measure of how expensive something is.
Exactly. Let's use the examples from the source. If the market's PE is, say, 10, that means you invest 10 rupees to earn 1 rupee of profit. But if the PE is 30, you have to invest 30 rupees to get that same 1 rupee of profit.
So a lower PE means the market is cheap, and a higher PE means it's expensive. It's that straightforward.
It is that straightforward. Your goal is to buy when earnings are cheap.
Okay, so how do I, as a beginner, use this? Do I have to calculate this for every company? That sounds complicated.
Not at all. This is where you use what the sources call the investment thermometer, and that's the Nifty YPE.
Because the Nifty Y tracks the top 50 Indian companies.
Right, so its overall PE ratio gives you a really reliable snapshot of the whole market's valuation. You can look it up in seconds. It tells you if the market, in general, is hot or cold.
And when you look at history, this thermometer is, wow, it's incredibly predictive. The sources show that when the Nifty YPE was low, like in that 10 to 13 range, that was the time to be brave.
The proof is just overwhelming. I mean, look at the numbers. In 1999, the PE was around 12. The returns after that, 105%. In 2003, PE was at 11. Returns hit 116%.
And after the 2008 crash, which everyone was terrified of,
PE dropped to 10, and the returns that followed were 130%. The lesson is, when the market is cheapest, your potential reward is at its highest.
But the flip side is just as important. When the PE was high up in that 25 to 30 range, that's when greed was peaking. And that was the time to be cautious.
Yes. In the year 2000, PE was at 28. What happened next? A 53% loss. 2008, same story. PE hits 28 again, and investors faced a staggering 64% loss.
So the lesson is, when the market is expensive, don't be greedy. When it's cheap,
don't be scared. But people do the exact opposite every single time.
Why? Why do we keep making the same mistake?
It's those 4 words, the 4 most dangerous words in investing, according to Sir John Templeton. This time it's different.
Ah,
Everyone convinces themselves that this boom is different. It's new tech, it's a new government, whatever. So the old rules of valuation don't apply. But they always apply. The market always, always comes back to its average.
okay, so that sets the stage perfectly. We know how to take the market's temperature. Now, what do we actually do? Let's get into the practical rules for wise investing.
Let's do it. Rule number 1, and this is the big one, buy a business, not a price.
Meaning, look past the stock ticker. You're buying a piece of an actual company.
Exactly. You have to do your homework, check their sales growth, their profit growth, how much debt do they have, who's running the company, is there a future for what they sell? A bad business will always have a bad stock price eventually.
Rule 2 feels like it connects back to the tips problem.
Oh.
Avoid pump and dump schemes.
Oh, absolutely. If some guru on social media is guaranteeing returns or pushing a penny stock that's hitting the upper circuit every day, just run. Run the other way. It's a trap set for beginners.
Rule 3 is about mindset. Long-term focus is the winning strategy.
The data is so clear on this. Short-term traders mostly lose. Long-term investors win. You get lower taxes, you have lower risk, and you get the power of compounding. The Warren Buffett quote here is the gold standard. If you can't hold a stock for 10 years, don't hold it for 10 minutes.
Okay, now let's shift to the preparation side of things.
Yeah.
Rule 4, safety first. This is about what you do before you invest.
Yes, you must have an emergency fund. At least 6 months of your expenses sitting in a safe place. And you need health and term insurance.
Why is that so critical?
Because it stops you from being a forced seller. If a crisis hits and you need cash, the last thing you want is to sell your investments when the market is down. That's how you lock in huge losses.
Rule 5 is simple and brutal. Never borrow.
A loan plus the stock market is just a recipe for disaster, period. Don't do it.
And rule 6 is for people who hear all this and still feel like they can't time the market perfectly. Use a SIP, a systematic investment plan.
Right. A SIP automates discipline. It's based on something called dollar cost averaging.
Which just means you invest a fixed amount of money regularly.
Exactly. So when the market is low, your fixed amount buys more units. When it's high, it buys fewer. Over time, it averages out your cost and saves you from putting all your money in at the absolute peak.
Rule 7 is for your sanity. Don't over-monitor.
Please don't. Checking your portfolio every day just cranks up the fear and the greed. You'll be tempted to react to every little bit of news. The best investors check weekly or maybe even monthly.
Rule 8 brings us back to basics. Understand your investment.
Simple test. If you can't explain what a business does in one sentence, don't buy its stock. If you don't get it, you can't assess the risk.
And that brings us to the last 2, which really summarize everything. Don't chase quick money, and understand that knowledge is not optional. It is the price of entry.
That's the whole game right there. So for you listening, the path is clear. Stop chasing tips, start watching the Nifty PE, study the fundamentals of a business, and build that discipline, starting with your emergency fund.
The final takeaway then is really empowering. The stock market isn't risky. What's risky is a person entering that market without knowledge.
That's it. You are the variable. The market is just the market.
And that leaves us with one last thought to chew on. If every market crash in history was preceded by smart people saying, this time it's different, what assumptions are you holding right now that might be ignoring the lessons of history? What is the next principle you need to master to make sure your discipline holds up through the next cycle? Keep that question in mind. Thank you for joining us on this deep dive.